Welcome to The Explainer. Guys, right now, we are witnessing an absolute explosion in the world of physical AI and robotics. I mean, we're talking about humanoid robots actually walking factory floors, advanced robotic arms completely transforming commercial kitchens, and autonomous systems that are gearing up to fundamentally change global manufacturing. It is an incredibly exciting space, and naturally, everyone wants a piece of it. But getting that piece isn't quite as straightforward as you might think. So that brings us to the million-dollar question we're answering today. How do the everyday retail investor actually get to invest in a private robot boom? Because let's be real, the companies building these incredible machines aren't trading on the open market like Apple or Tesla. They're pre-IPO tech companies heavily guarded by venture capital. Traditionally, retail investors are entirely locked out of the ground floor of these massive technological shifts. But recently, a new financial vehicle has emerged, claiming to offer a backdoor into these exact private assets. Okay, let's dive into this. Here is our roadmap for today. 1. The pre-IPO robotics boom. 2. Inside RoboStrategy's fund. 3. The premium harvesting engine. 4. Market price versus NAV. And 5. Peeling back the risks. Let's get right to it. First up, Section 1, the pre-IPO robotics boom. We are seeing literal billions flowing into physical AI. Just look at this jump. In 2024, robotics funding was sitting around $8 billion. But by 2025, bam, that number skyrocketed to nearly $14 billion. $14 billion. That is a staggering influx of capital in just a single year. Capital is flooding into the physical AI sector much faster than traditional public market vehicles can even absorb it. And this massive wave of funding is creating some truly astronomical private valuations. Just consider the names commanding all this cash. You've got Figure AI, which recently hit a massive $39 billion valuation mark while building humanoids. Apptronik, they tripled their valuation to around $5.5 billion. Then there's Standard Bots, who create AI-native industrial robots you can literally teach by demonstration rather than coding. They just raised a $200 million Series C at a cool $1 billion valuation. And Dyna Robotics, boasting a 99% operational success rate with their stationary dual arms, is sitting at over $600 million. These companies are completely transforming industries, but again, they are entirely private.
Which brings us to Section 2, inside RoboStrategy's fund, or as I like to call it, the retail backdoor.
So to give everyday folks like us access to those exact private companies we just talked about, a company called RoboStrategy listed on the Nasdaq under the ticker BOT. But heads up, it's not a traditional company, it's a closed-end management investment company. What that actually means is it's a fund with a fixed number of shares that trades on an exchange exactly like a regular stock. And because its capital is permanent, it isn't forced to return money to investors on some strict venture capital timeline. It can hold on to these private pre-IPO robotics companies indefinitely. Well, the market's reaction to this new ticker was, in a word, explosive. Driven by sheer retail enthusiasm for the robotics sector, BOT stock quickly began trading at roughly $41 to $45 per share on the Nasdaq. Investors were just thrilled to finally have single ticker exposure to big names like Figure AI and Apptronik. Now, what's really interesting about this slide is the catch. While retail investors were out there happily slapping down over $40 a share, the SEC filings revealed something wild. The fund's actual net asset value, or NAV, was a mere $7.31. Yeah, this means buyers were paying a massive premium over the estimated value of the actual robotics assets held inside the fund. So why on earth list with such an enormous gap? That brings us to Section 3, the premium harvesting engine, also known as the MicroStrategy playbook. RoboStrategy's CEO Andrew Kang explicitly models this fascinating financial loop. Let's walk through it. Step 1. The stock trades at a high premium driven by market hype. Step 2. Because the stock price is so high, the fund issues new shares at that elevated price. Step 3. The fund takes that massive influx of cash and buys even more private robotics assets. And Step 4. Because they raise cash at a premium, the net asset value per share actually increases for everyone. When this engine runs forward, you guys, it essentially prints money. It justifies the premium by continuously boosting the underlying asset value per share. But engines don't run smoothly forever, right? Time for Section 4, market price versus NAV. Let's talk about the lagging indicator. This is absolutely crucial to grasp. You have to understand the profound disconnect between these two metrics in the specific fund. The market price trades live. Every single second, it is hyper-volatile, driven entirely by public sentiment and hype around robots. But the net asset value? that is not a live price. Because these are private companies, the NAV is literally just a quarterly model estimate. It's based on delayed private funding rounds. So you are comparing a live second-by-second sentiment indicator against an opaque estimated model output that updates on a massive, massive lag. And this brilliantly illustrates Warren Buffett's core investing philosophy: price is what you pay, value is what you get. When you buy a closed-end fund packed with private companies at a giant premium, you are paying a very high, very real price today for an estimated delayed value. You absolutely have to watch the gap between the two, not just the stock price. Which brings us to our final and honestly most important section, Section 5, peeling back the risks and the 3 layers of danger. Look, when you invest in a vehicle like this, you are actually taking on 3 distinct layers of risk. Layer 1 is sector risk. Physical AI is heavily tied to massive capital expenditures. It's cyclical and highly driven by market hype. Layer 2 is idiosyncratic risk. This fund is heavily concentrated. If one of these private companies stumbles, for instance, if Figure AI suddenly loses a robotics pilot program at a BMW plant to a competitor, that failure won't show up in the fund's NAV until months later. It leaves retail investors completely in the dark. And then layer 3, premium risk. This is the danger of that premium harvesting engine breaking down. To really cement why that premium risk is so extreme here, let's consider the alternatives. If you buy a standard robotics ETF like BOTZ, it holds public stocks. The NAV updates live all day long, so the premium risk is very low. If you evaluate MicroStrategy, sure, there's high premium risk, but its underlying asset, Bitcoin, prices live 24/7. However, RoboStrategy's BOT fund holds private estimates updated on a quarterly lag. Because the underlying assets are completely unpriced and delayed, the fund can become completely detached from reality. It creates this extreme risk that the premium could collapse before the NAV ever even updates. So I want to leave you with this final provocative thought. We saw how the premium engine builds value when the stock goes up, but what happens if the hype cools and that engine suddenly runs in reverse? If the market price falls and the premium vanishes, the fund can no longer issue new shares without severely diluting its investors. The very mechanism defending the stock price just disappears. The private robotics boom is undoubtedly real, for sure, but as always, the vehicle you choose to ride into the future matters just as much as the destination. Thanks so much for joining me on this explainer, and I'll catch you guys next time.